discussing how to identify the best wave count when you're faced with multiple wave counts. All of the major points I make today are covered with extra detail in Frost & Rector's Elliott wave principle. I keep a copy of it on my desk at all times, and I refer to it often. Every time I read it, it seems I come away with something new, a new idea that I hadn't noticed before, perhaps just reading a sentence or a paragraph just a little bit differently, or a little nuance to it that I hadn't considered before. So I'm always reviewing it, and I've been reviewing it for the last almost 40 years since the first time I read it in the mid-1980s. And I've analyzed markets for more than 30 years. And the wave principle has always been my primary, if not only approach. I often wonder why everyone isn't using the same method. One reason might be the method, the dimension of alternate counts. You can see on this slide paddle chart that I offered a bearish alternate count. It's a bearish count generally, counting 1, 2 to the downside, but above that 2, this is across for about the 184 level. You look above it, you'll see Alt A. If you're a follower of the wave principle, you might see an alternate labeling like this on your charts. And that may raise a question. I think often it makes people think that there's different possibilities in the market, therefore there's doubt in the forecast for the market, and that's a bit of a turn-off. And I can understand that, and that's how I viewed it originally. But that's not how I view it anymore. Yes, at times, it could mean there's indecision in the market, but I've noticed that most times, the alternate count points at least in the same direction from a trend point of view as the primary count does. And in that regard, I'm looking at two possible counts, but they both suggest the market's going to trend in the same direction. So I see this as a positive rather than a negative. The alternate count doesn't necessarily create doubt about the future path the market might travel. It often adds confidence to one's outlook. It took me a long time to reach that conclusion, but I think it's one of the most confusing aspects of the wave principle. So when you're faced with multiple wave counts, how do we juggle those? How do we determine which one should be operated or primary count, which should be alternate? And by the way, there might be more than 2 counts available. Often there could be 3. I'm sure I've counted as many as 5 different possibilities at one time. We go through a rating system. And the ratings are based on how well each count that's available follows the wave principle rules and guidelines. The latter guidelines includes common relationships between related waves. So again, grading each count with the rules and guidelines helps us determine which count we should favor. So let's go ahead and move through the rules. Normally there are 3 rules, but for this discussion I've expanded the list. Wave 2 always retraces less than 100% of wave 1. Wave 3 always exceeds the end of wave 1. Wave 3 is usually the longest and it's never the shortest amongst the 3 actionary waves, 1, 3, and 5. In a traditional mode of wave or impulse wave, wave 4 does not enter, or at least doesn't end in the territory of wave 1. Overall, try to avoid it, except for in a diagonal triangle. In that particular pattern, wave 4 almost always overlaps wave 1, considered almost a requirement. I mentioned 3 rules, you have 3 or 5 bullet points, but the 3 rules, just to mention them again, is the wave 2 does not retrace, wave 2 does not retrace more than 100% of wave 1. Wave 3 is never the shortest of waves 1, 3, and 5. And wave 4 should not overlap wave 1. So here's the idealized Elliott wave progression. All of those rules apply here. Notice wave 2 ends well above the portion of wave 1. Wave 3 looks about the same distance as 1, 3, and 5 in this idealized chart, but normally would be the longest or extended wave, and I'll get to that in a few moments. Wave 4 is above wave 1, and then wave 5 normally goes to a new high or the end of wave 3. Very simple progression. When the market's moving along this path, it's usually when the trend's to the upside. Usually the trend is obvious. This part of the pattern is clear. And when we can count 5 waves from a significant low or 5 waves from a significant high, everything I'm saying here, you could flip over in a bear market scenario. When we finish 5 waves, it's time for a correction. So the 5 waves that I showed earlier now become wave 1. You can see of a larger progression to the upside. Once those 5 waves are complete, that entire sequence is going to be corrected in a larger degree wave 2. And it should retrace no more than 100% of the larger degree wave 1. Same rules apply at multiple degrees of trend. The wave principle is fractals. It's fractal in nature. We're looking for predetermined price paths. There is limited numbers, but they repeat themselves at different degrees of trend. For ease, I would say different time frames, but technically different degrees of trend. And once that 1, 2 is finished in the prior slide, that becomes wave 1 and 2 of an even larger 5-wave advance. And when that's complete, there'll be a 3-wave corrective setback as shown. Constantly moving to the upside. This wave principle is all about progress and growth. My job on a daily basis when I'm looking at markets is to identify where the market is located within this idealized Elliott wave progression. If I can identify a market at the end of wave 2, then I know what should lie ahead. Waves 3, which ideally will unfold in 5 sub-waves. Then there'll be a 4 and a 5. We provide the trend until we believe 5 waves at a larger 3 have ended. It's often said that there's an exception to every rule, and the ending diagonal pattern that I mentioned earlier is that exception. Actually, one of the rules is that wave 4 should not overlap wave 1. But in this particular pattern, as I mentioned earlier, it's almost required. In this pattern, which often unfolds in 5th wave positions and C wave positions, waves in both directions usually unfold in 3 subwaves, and wave 4 almost always overlaps wave 1 of the same degree. Easy so far. When we look back at this idealized Elliott wave progression, where you're going to usually see alternate counts is in the corrective portions, the wave 2s, the wave 4, and B waves. And this is at any degree of trend because corrections, while shown here as simple A, B, C, or 3-wave movements, can take on different paths, different patterns. Here they are. We normally group them into categories: zigzags, flats, and triangles. But at the bottom, you can see there is a fourth possibility. At times, the correction will include more than one correct pattern. We refer to these as combination corrections. 5-wave start to the zigzag usually allows us to identify the proper pattern, the zigzag. Because in contrast, you'll notice that flats and triangles start with an additional 3-wave movement. The market's wave position along the Elliott wave progression might help us identify the pattern, though it might be unclear whether a flat or triangle is unfolding. And it's that doubt that results in an alternate count, usually. So for instance, as I mentioned, the zigzag starts with a 5-wave movement. So we know right off the bat that's wave A. of an ABC movement 5-3-5. Basic definition of a zigzag. When a flat begins, the first wave, wave A, unfolds in three waves. That could represent all of the correction, or it could represent wave A of the ABC flat correction you see in the middle top of the screen. A second three-wave rise that retests the origin of the correction and might even push to a new extreme is followed by a five-wave decline that reaches a new low. So this is one of the wave positions where you'll see that alternate count pop up. Sometimes you'll see the setback in three waves, and as an analyst, I'll say that could represent all of the correction, whether it be wave 2 or wave 4. So I'll tend to label the correction complete, but as the alternate count, I'll put an A on the chart to say that could be just the first wave of a longer lasting, more complex corrective pattern. Let's look at an example of a couple rules in action here. This is an example of what I refer to as the wave 2 rule. Remember, wave 2 cannot retrace more than 100% of wave 1. This chart reveals that May soybeans rallied 5 waves from 1128 and a half. Since we cannot count the rally as the end of a larger movement, a fifth wave or wave C of a correction, either a zigzag or a flat, it had to represent the first wave of a larger upward movement. Remember, even corrections unfold in three waves, A, B, C. Based on the rule and the understanding of the wave progression, we concluded that the subsequent setback should prove corrective. It should end no lower than 1128 and a half. Beans did turn lower, and given the overlapping nature of the slide, it does look corrective when viewed in its totality. By the time it ended, we had rolled to the July contract, and beans bottomed above its 1140 and a half low. Remember, second waves can retrace up to, but no more than 100% of wave 1. The end result was as expected. After a corrective setback, July beans rallied to a new high, and it did so in 5 waves, as you can see here. Again, I often refer to this as the wave 2 rule. This chart of live cattle shows the same rule again, but instead of wave 1 from the low at 168.50, I've labeled it as wave A, the first wave of a corrective rise, a zigzag, and that meant that wave B could retrace like wave 2 up to, but no more than 100% of wave 1. Here too, we saw a very deep correction, kind of unusual, but allowed by the rule. Afterwards, we saw the rally from 170.28. As expected, wave C reached a new high above wave A, but notice it did so in 5 overlapping waves. That's an example of an ending diagonal. Each subwave unfolded in 3 waves, and wave 4 overlapped wave 1. Also notice that wave 3 traveled a shorter distance than wave 1. Since wave 3, by rule, cannot be the shortest of waves 1, 3, and 5, wave 5 was limited to the distance traveled in wave 3. That put a ceiling over the market at 192.05. The actual high was 189.05. So this is an example of using, again, rules, so in this case, the wave 3 rule, to identify where the market shouldn't go if the count is correct. We can look at what happened afterwards. Notice the wave 2 had the high at 189.05. Notice the abrupt reversal and the sharp decline that followed. Typical price action following the completion of an ending diagonal. This is the same chart I showed earlier. And based on the count you see here, we were looking forward for a strengthening decline in wave 3 of 3 of 3. Third wave usually represents the strongest wave within an impulse movement, an extended wave. And if the third wave subdivides into 5 waves of its own, the third wave of the third wave should represent the strongest segment of the strongest wave. Sticking with this, moving down into the short term, the wave 2 rules identify 179.32 as the ceiling for out from 173.72. A breach of that level would eliminate the count as shown. At that time, we would adopt the alternate count that suggests wave A of a larger wave 2 correction ended at 182.52, and the 3-wave decline to the low at 173.72 represents the end of wave B. Since the correction occupies the wave 2 position, we would not anticipate a triangle. That leaves us with a likely expanded flat correction. So we look for wave C to rally 5 waves and reach above the end of wave A to complete the pattern. It's important to note here that while if we made the switch to the alternate count, it would change the short-term trend to the upside, looking for that rally above 182.52. It wouldn't change the dominant trend of the market. It would still be to the downside. The rally would complete a larger corrective rebound to flat. And once it's complete, the decline from 189.05 would continue. Next, we're going to take a look at guidelines. Guidelines aren't as important as rules. They are common, but not required. While wave counts should abide by the rules, they are not limited by the guidelines. So the more guideline the count satisfies, the higher rank the count will be. Take a quick look at some extensions. Within an impulse movement, that's a 5-wave movement, it's usually the third wave that extends. Now, wave 1 could be the extended wave, wave 5 could be the extended wave, but in my experience, the vast majority of the time, the third wave will be the extended wave. You can see that on the left side. When that occurs, there's another relationship we watch for. That is that wave 5 will often travel a similar distance as wave 1. Wave 3, when it's extended, will often travel 1.618 times the distance traveled in wave 1. Though it's not limited to that, it'll give us a ballpark estimate of where it might be going. What I'm really looking for in the extended wave is to be able to count 5 subwaves to their completion. And at that point, the market's near that Fibonacci relationship, 146.8 times the distance traveled wave 1, that confidence grows that the market's nearing the end of wave 3. Alternation is another guideline that I'm always using. It suggests that in an impulse wave, waves 2 and 4 usually follow different paths. If wave 2 is sharp against the trend, wave 4 will likely take a sideways fall. If wave 2 is that's a sideways correction, wave 4 will typically be sharp. Thinking back to the different corrective patterns I mentioned earlier, I consider a zigzag, a double zigzag, a triple zigzag to be examples of sharp corrections. Flats and expanded flats and triangles are examples of sideways corrections. So when I'm rating, again, different counts, I'm looking at a guideline of, do I have an extension? Do I see alternation between the wave 2 and wave 4 correction? Here's an example of both extensions and alternation. This is a chart of December soybean meal. It shows both wave 3 traveled a multiple of the distance traveled in wave 1. Far more than the usual 1.618 times wave. But it is a unified decline. Wave 2, you'll notice, unfolded as a flat. Notice wave B actually moved to a new extreme within the decline, the peak, the end of wave one. Looking further along the market's progression, wave four is sharp. It's a zigzag. There is no retest of the origin of the correction. So we have an extended third wave here, and we have alternation. We would rate this wave possibility as high. This is a likely correct wave. The wave principle also helps us identify where corrections might end. When a 5-wave sequence is complete, the subsequent correction of that movement, in this case the rally, will all provide support in the area of the fourth wave of one lesser degree. And that's particularly true when the correction underway itself is itself a fourth wave. I use this guideline, almost called it a rule, this guideline often. It's the first, this guideline gives me the first idea of where a correction might end. But it's not the only method of identifying where a correction might end. We consider Fibonacci retracements. Corrections often retrace a Fibonacci 38.2% or 61.8% of the wave they serve to correct. I have found that second waves are often the deeper of the two corrections, wave 2 and 4. Because during second wave corrections, the crowd often believes the old trend is intact. And they see that bounce as an opportunity to join that where they see that setback as the old trend resuming, and they're selling it, so therefore it travels a bit deep. By the time fourth wave correction comes along, usually the third wave is extended, the crowd believes the trend is now to the upside. So when they see a pullback, it's an opportunity to join the trend. And that action usually makes wave 4 a bit shallower, retracing the 38.2% of the distance traveled in wave 3. And remember, wave 4 shouldn't overlap wave 1, so we always draw a line there. So you can see why wave 2 would be the deeper of the two corrective patterns. Not always, but usually. We also look at internal relationships within the correction. Here we're looking at a zigzag 5-3-5. Wave C in a zigzag often travels the same distance as wave A. And if the zigzag, a single zigzag does not finish the correction, say a double zigzag, as shown on the right, we'll look for the second zigzag to travel a similar distance as the first. In flat correction, wave C is also replaced by the 6.8 multiple. Because what we're doing is there are different ways to calculate where a correction might end. We have the area of the fourth wave to a lesser degree, it's extreme. We have internal relationships within the different patterns, zigzags, etc. And we have just the standard 38.2%, 61.8% retracements of the prior wave corrected. And together, these will often give us a fairly tight target area of where a correction might find support and come to an end. But always about wave structure. The correction is not over. You don't count the price structure. That 5-3-5. Flat 3-3-5. From an alleyway perspective, price structure is more important than any of these measurements. But the measurements are often helpful. Now, another guideline is using semi-mod versus just your normal chart. And this, admittedly, is something that I don't usually pay a whole lot of attention to. Most of my work on a very short-term basis. When we're looking at long-term charts, it's often helpful to to look at the semi-log scale. Now, recently I saw an example where I did make note of the different ways to chart, and it helped me in making a decision. Here we have soybean meal, daily chart of soybean meal that shows the positive exact for 1740. Weight C travels a similar distance as weight A, and as I previously stated, equality in the zigzag is a common relationship, so we're looking for a low here in soybean meal. Contrast that with this chart of soybean meal. From the right side, counting ABC movement, but in this case, weight C looks out of proportion to weight A. It's noticeably shorter. However, if we were to compare the percentage drop associated with each wave, you find that they travel a similar distance. Wave A dropped 25.85%, almost 26%. Wave C dropped 22.97%, or close to 23%. So on that scale, each wave traveled a similar distance, suggesting that, in a way, wave C equals wave A on a percentage basis. So you want to keep track of your charts using both methods, both chart formats. I typically do this, again, looking at long-term charts weekly and monthly. It puts everything in proportion. And I should mention that word proportion is very important to me, because there's another guideline called the right look. And that means looking for that extended third wave, looking for the alternation, sort of encompassing. All right, Elliot, it's about the right waves. But when we consider the guideline of the right look, I do like when corrections 2 and 4 of the same degree unfold over a similar duration. Doesn't have to be exact, just ballpark, just eyeball. And when it does, it satisfies the guideline of the right look. Now, we also consider wave personalities. I rely on this more and more, have relied on it more and more as my career has progressed. There's wave personalities for impulse waves and corrective waves. You'll find this chart and the upcoming idealized corrective wave chart in Ross and Prechter's Elliott wave principle. So I'm not going to go into detail here, but I've already mentioned that when a trend is changing, in this case from a bear trend to a bull trend, wave 2 is often a deep correction, because traders believe that after a rebound, probably a correction from their point of view, when the market starts lower, it's the resumption of downtrend. They want to get involved. From an Elliott wave perspective, or anticipating a mortgage curve. But with most traders looking lower, you get a correction. As wave 3 progresses and extends, traders become convinced that they have it wrong, so they have to reverse course. So they're buying to cover their shorts, they're buying to establish long positions, to take advantage of the new trend, and that's what drives the market higher. Similarly, wave 4, for those who haven't climbed aboard the trend yet, see the setback as an opportunity. And it is, but it's an opportunity just for a push to a new high in wave 5, and ultimately wave 5 becomes a disappointment because it's reversed and retraced back to the upward wave. So sort of my summary of trader emotions, the crowd's emotions along the way in a 5-wave movement. In a correction, wave A to the downside is viewed as, oh, here's a setback in a larger advance, and we're pushing trend here. So it's an opportunity to buy. Wave B occurs, it's a rally attempt. From the LA Wave perspective, we believe it will fail and fail after 3 subwaves at DC. And when wave B gets going, the break to the new low beneath the end of wave A is a huge disappointment and drives people out of the market. From an LA Wave perspective, we see it as the final wave in a correction. Let's go through some examples. Here's the live paddle again. Using just the rules, we previously identified 179.32 as the ceiling for this bearish outlook. A breach of 179.32 would eliminate the series of first and second waves and suggest a rally north 182.52 would complete a larger wave 2 correction. I mentioned this earlier. It would complete a flat, and then the bear trend would resume. Again, just using that wave 2 rule. You can see that the market did breach recently 179.32. So that bearish count was eliminated, or the immediately bearish count was eliminated. And we elevated the flat count to preferred status. So again, wave C is likely to exceed the end of wave A to complete the flat correction. Furthermore, now that we switched counts, there's work to be done. Wave C will travel 1.618 times wave A, just below the 61.8% retracement target at 184.20. So we have a target cluster building right around 184 for the end of wave C and the end of wave 2. Once it's complete, the larger downtrend should resume. In soybeans, we looked at soybeans earlier. Lead hogs, the similar impulsive rally, it's low at 68.05. It doesn't look like the end of a larger rally, a fifth wave or a C wave. So the rise from 68.05 likely represents the first wave of a larger advance. But we did expect a corrective setback. And you can see on this chart, even though it's a daily chart, that the setback started with an initial 3-wave setback that could have represented all of the correction. If you take a closer look on the hourly chart, you can see the rally labeled as wave A. But during the correction, there was an ABC that marked as W. That could have been the end of the correction. And this is important. I've learned over the years that if I count a correction complete, I should do so. And at the time, in real time, when looking at the chart, I did put wave B at the end of that ABC and suggested now that lean hogs would rally in wave C. We can see the market did rally, but that rally never developed the 5 waves. Instead, there were 3 waves up, and then the market fell back below 76. The overlap that created signaled that this corrective setback was still underway. So I had to relabel the chart. The initial zigzag became W. The rally is X wave, and now we see a second zigzag correction to 71.32, now labeled as wave B. A deeper correction just a bit more 61.8%, 68.05. As an example, I have to change the count again, but not the overall outlook. This is an important distinction. Early in my career, I was all about the count. What's the right count? As I progress and gain more experience, for me, I've decided that I'm using the wave principle to stay aligned with the trend of the market. So if I believe, as I did here, that a correction is complete where the W label is located, I turn bullish. But my alternate count's going to be that could just be wave A of either a flat or, as in this case, a double zigzag. The rally from the low through 74.65 ended that the correction was over. It was plenty deep enough, having retraced more than 61.8% of the prime rally, but it signaled that wave C was likely underway. And you can see the outcome where the market lies today. And then wave C has progressed nicely. In fact, it has now traveled the same distance as wave A and is trading just above where the correction in wave B, remember we're counting ABC for wave B, has traveled or has retraced 61.8% of the decline from 89 to 40. So I have a small cluster of targets. I've looked at the market recently, and I'll say it does not look like wave C is complete structurally, but it's getting close. So again, here's an example of dealing with an alternate count, using the rules, using the guidelines to stay in tune with the market's trend. And in this case, if the rise from 68.05 is a correction, as shown here, while it might not be complete just yet, it should be very close to an end. Now here's a long-term chart, a monthly chart of soybean oil, and it shows a developing bullish triangle. We only recently arrived at that conclusion, going back to the wave 3 high on the left side of the chart. The initial setback or decline, since we're looking at a monthly chart, it was lengthy and carried a great distance, but that initial decline was in 3 waves. And it could have represented all of when initially back then, we did have a wave 4 label underneath the low at 24.68. We're expecting a rally, not only a rally, but a rally that exceeded the end of wave 3 in the wave buying position. You can see the market did rally, and it did exceed the end of wave 3. But you might notice that to 87.65, we can only count 3 waves to the upside, A, B, C. That was a signal to us that while the market satisfied upside expectations, the correction that dated all the way back to around the start of 2008 was still underway. And then considering the various corrective wave patterns available to us, a correction that starts with 3 waves to the downside in this case, then a 3-wave rise to a double top or a little bit beyond, narrowed the possibilities to either an expanded flat or a running triangle. Both of those scenarios or patterns suggested that the next move in the market would be to the downside. Wave C of a flat should reach beneath the end of wave A at 24.68, while wave C of a triangle should end after 3 waves or a combination of 3 wave movements, but end no lower, usually above the end of wave A at 24.68. But here again, I'm looking for noticing the common thread between the 2 counts available to me. One would have been deemed primary, and the other as the alternate. Usually, I'll go with the flat first as the primary, and the triangle as the backup or alternate count. What would separate the 2 counts is how wave C progressed. And you might already notice we have a WX, which suggests it's a corrective move to the downside, not an impulse wave. You can see we counted it as ABC, followed by an X wave. So we're looking for another ABC. The market's progressing along those expectations. Wave C of the second zigzag will travel the same distance as wave A at 27.89. So we have a downside target. The structure favors the triangle instead of the flat. So that has become, in my long-term work, that has become the preferred count. But again, I want to reiterate that as wave C got underway, wave B coming to an end, wave C get underway, both the preferred count and the alternate count, both the flat and the triangle, call for a sizable decline in soybean oil. and we've seen that decline. This is how I believe that alternate accounts impact confidence to our outlooks of the markets. I had two accounts available to me, and they both suggested that soybean oil should stage a sizable decline, and they have. So again, I think it's an advantage to the Wade principle that there are sometimes alternate accounts. Now, there are times when they're going to be in opposite directions, and that's a signal maybe to step back from the market. The pattern should agree on direction, especially in the short term. You step back from the market because confidence is lower. That's, again, another way that I use alternate accounts. So, in closing, how do we evaluate and choose primary count? Which count is primary and which is alternate when we have multiple counts available to us? Well, we consider each count and how well they're adhering to the rules, although all rules should be followed, adhere to the guidelines, and to relationships between waves, including Fibonacci relationships. The count that best adheres to the rules, guidelines, and relationships will be your preferred count. The one that count or two that does not meet the same level of adherence to expectations will be your alternate counts. But at the end of the day, future market movement will dictate which count is the correct count. The Wade principle is all about price movement. It will determine the proper count. So with that, we come to the end of how to evaluate and choose primary and alternate counts. I hope you found this presentation helpful and that will advance your knowledge of the Wade principle.